Hey all, welcome to ShareTreck. This is Raj here, and this is our Saturday edition. And today we are going to talk about how the global financial environment impacts our stock market price movements. So let's get started. So here we are in North America. We are using our US dollars and the Canadian dollars, or maybe the peso. And most of our goods are coming from across the globe, mainly manufactured in China or Korea or India or Turkey or somewhere like that. And we pay them in our currency, and by magic it reaches the people who manufacture it across the globe, and they get the money. So the international financial system is the blood for the overall global economy, and it flows from one place to another. And today we are going to examine why funds may flow from one place to another and what impact it will have on the economies and the shares. So let us first start off by examining what is the current state of the world. That will be the first step. Let us see what is the economical condition of some of the big players, for example, and then we'll talk about what would happen to their economical system, and if that happens out there, what is going to happen in North America. So we'll do something like that to get an idea, because this the scope of the discussion is much wider, and we don't have much time, and we are trying to confine everything within a 25 to 30 minute time frame. So let's get started. The first concept I would like to talk to you about is liquidity. Liquidity is the amount of cash that is available in an economy. Let us take the case of, let's say, Canada. High liquidity means there is more money in circulation, and people are able to get the money easily, and they are able to transfer it easily, and things are fine. When the central bank increases the interest rate, the liquidity reduces, because instead of circulating among people, the money goes into fixed deposits or guaranteed investment certificates or bonds, because interest rate is higher. And as a result of which the volume of money in circulation goes down, and we say that the liquidity has decreased. When the liquidity decreases, then the goods and services have to compete along with the fixed deposit instruments to attract money. And as a result of that, the goods become cheaper, and people are willing to spend on those goods. So this is the relationship. So when the interest rate goes up, the money gets sucked, liquidity gets sucked out of the economy, and therefore there is less money chasing more goods. Everything being constant, the price of the goods has to come down, the value of the money goes up. So this is the way we can look at liquidity and the relationship between interest rates and price of commodities, everything else being constant. And that said, we have got so many countries in the world, and each country has got its own economy. They have their own political system, and they have their own priorities. As a result of their priorities and their political system, the state of economy is different for each of the countries. Some countries are closed countries where their exchange is controlled by the central bank, and you cannot take the currency out of the country. And they also ration out how much money can be taken out of the country by its own citizens. So they control how many dollars they can buy. We have a whole lot of currencies in the world, a whole lot of economies in different situations, and as a result of which their economic policies are divergent. And this is where we have a problem when we look at an economic union like the European Union, which has got multiple countries, and the European Union is trying to get all of them harmonized. But the fact remains that many countries in the EU have a high inflation rate, while many others have got low inflation rates, and the same prescription may not work equally for all of them. So that said, let's take a look at some of the major economies and see what is their current situation. Our objective is to anticipate what each of those economies are going to do next and how it is going to impact the US dollar index, and therefore how it may impact the stock market. So that's what we're going to do next. We already know that in US, what is the condition? We know what's the interest rate right now. We know what are the problems that we are facing. We also are aware that there's going to be 75 basis point hikes. We have labor shortage, and all that is clear for us. Now, if we look at the rest of the world, I have the graph here from World Economic Forum, and the World Economic Forum has released this information for us with legends out here. They haven't put the name of the countries, but more or less we know the names of the bigger ones. The color coding is that the lightest color is for the lowest inflation and the darkest color is for the highest inflation, and gray means there is no data. So we don't have data for much of the world in Africa, and also for parts of the Middle East and Greenland and parts of South America. However, the highest inflation rate is in Turkey, which is at 54.8. And remember, these are all first quarter 2022. Since then, things have worsened further, but even at that time, things were that bad. The next is Russia and parts of South America, and afterwards the most of the other countries are coming into the 5.1 to 7.4% range, which is Canada, Mexico, India, Australia, and also South Africa. So what this tells us is that worldwide we have got an inflation problem. Now let us look at Africa. I have got another source where I have information about Africa. It comes from Business Insider Africa, and here are the top 10 African countries with the highest inflation rate in Africa, and the inflation rate ranges from 245.1% in Sudan all the way down to Sao Tome and Principe at 14.5%. So nevertheless, things are really bad. Zimbabwe is slightly better than before at 86.7%, and all this inflation is because there is more liquidity and there are fewer goods that the liquidity is chasing. Therefore, the goods have become expensive. In ordinary times, we would say that, okay, mop up the funds, and it's a problem of having too much money in the economy. But right now, the problem for these countries are that they are lesser developed countries. Therefore, their consumer price index consists mostly of food and clothing and shelter. And food and clothing forms the biggest portion. And with the war in Russia and Ukraine, we have a situation where gas prices are high, and that translates into increase in price for all the things that these people consume. And most of the things they consume is food and clothing. And therefore, they are in a situation where they are being hurt the most. Whereas if you look at a G7 economy, there are other consumption baskets that the G7 citizens can give up. For example, they can give up going on a vacation, or they can give up going for a concert or something like that, because food and clothing form a smaller portion of their consumer price index as compared to what it would be for lesser developed countries. So this is definitely a big problem. There's another article which says inflation goes global. And again, this is an article which has come on January 23rd, 2022, which was yesterday. And it's talking about inflation in Europe. And it says in Germany, France, Spain, and Italy, the inflation has reached a record high of 8.1% from 7.4% in the previous month, caused by rising energy and food costs sparked by the war in Ukraine. It also says South Korea's inflation hit a 13-year high in April, raising 4.8% from a year before. And Korea's central bank said this week inflation this year would be exceeding a 4.5% annual forecast the bank estimated last month, citing the war in Ukraine, rising commodity prices, supply chain issues, and loosening of COVID restrictions, driving up consumer demand as major factors. So I guess I have made the point. We need not labor this point further. Inflation is a global problem. Now, what has US done to control inflation? US is raising the interest rates, and as I mentioned many times in my earlier videos, raising interest rate is just going to kill demand. It's not solving the supply chain problem. It's not solving the supply side problem. The supply side problem is coming from two sources. The first one is the Russia-Ukraine war, which is causing gas price hike and food price hike. And the gas price hike is going through everything. And the second is the supply chain problem, which is starting to ease up a little, because that's what I get to read from various media sources. So that's a good thing, but still the problem remains. And the gas price and food price, if they are not controlled, it's going to lead to stagflation. especially for Europe and for the lesser developed countries where food expenses form a bulk of the consumer price index, because they need food, and if food price goes up, they have no option but to pay the price, and their employment levels are going to go down. So it's going to lead them into stagflation, and it will be difficult for them to come out of it. So having established that, what is it that's going to happen? Now, I would like to first take a look at Japan, because Japan and China are two countries which have got very, very low inflation rate at this point of time. They have the exactly opposite problem. To understand what is happening in Japan, I'm going to look at this article from Economist Intelligence Unit, EIU. And the headline reads, Yen weakness undermines Japan's growth outlook for 2022. And there are some key points that are mentioned here. The Japanese yen has been one of the hardest hit major currencies in the wake of Russia-Ukraine conflict. Its sharp depreciation against the US dollar is derived from a combination of Japan's relatively weak economic fundamentals and a high degree of reliance on energy and food imports. EIU expects the yen to continue to depreciate against the US dollar in the remainder of 2022, owing to diverging monetary policy settings in Japan and the US. So US is facing a problem with inflation and Japan is facing a problem with deflation. So they have got very diverging monetary policy requirements, with narrowing real interest rate differentials diminishing the yen's attractiveness to international investors. Continued weakness in the yen will have limited support for Japanese exports owing to supply chain disruptions. However, it will constrain Japan's economic growth this year through stronger inflation and softer consumer spending and delayed business investments. Well, let me unpack this for us. When a country has got a weak currency because it has got low interest rate and it has got a deflationary environment, and the government is trying to boost the economy, just like what US did before when COVID struck, they reduced the interest rates, pumped a lot of liquidity in the market, and started jump-starting everything. So Japan is having a demographic problem, and Japanese people are very hardworking, but their economy has been very, very soft. And one of the unfortunate problems for Japan is that they import, they process, and then they export finished goods. So when the Japanese yen becomes weak, all the imports become very expensive. And therefore, the export product that they are creating becomes expensive. And therefore, their competitiveness globally goes down. And due to the COVID crisis and due to the Russia-Ukraine war, oil has become very expensive. Metals like palladium and a lot of minerals have become expensive. So Japan is facing an import price increase like all other countries. And also it's finding that its exports are getting softened up. And it has to continue to manage the yen. And if the yen goes below above 140 to the US dollar, then it is believed that the Japanese government will have to initiate some measures to prop up the yen and prevent it from going into a free fall. So that's what is in cards for us in Japan. To understand the other economy which is having similar problems like Japan, I'm looking at the World Bank article here published on June 8, 2022. So it's fairly recent, which is titled China Economic Update June 2022. So basically what it says is that China's economy is projected to slow in 2022 after a strong start in early 2022. The largest COVID-19 wave in 2 years has disrupted China's growth normalization. We project real GDP growth to slow sharply to 4.3% in 2022, 0.8 percentage points lower than projected in December China Economic Update. And I was listening to Peter Zeihan in one of his recent videos while he was promoting his new book. I was wondering why China is doing a total lockdown. According to Peter Zeihan, the Chinese COVID vaccine is not working, so they have no option but to do a total lockdown. And if that is the case, then it has stopped industrial output. It's also affecting big companies like Tesla and others who have got plants in China, because the lockdown has put all the factories' production to a halt. And therefore, there is no productivity going on. And before all this happened, China had a problem of income inequality. The rural areas didn't have as much prosperity, and the government wanted to bring some kind of equality, and they were experimenting with various methods of distributing the wealth more equally among the regions of the country and among the various classes of people. So all those things were already happening in China before COVID struck. And now with the COVID lockdown going on and with the zero COVID policy, China has entered into a funk. Apart from that, on top of this, there is this geopolitical complication where there is a regional rivalry going on and China wants to dominate Asia. And therefore, it has had some tie-up with Maldives to have a naval base out there. And it's also trying to do the same thing with Myanmar. And therefore, US formed the Quad with Australia, Japan, and India, and as a counterbalance. So there are other aspects also which are going on, which is bothering China at this point of time. In the recent past, China had done a lot of outreach to various countries in Africa and Asia and provided them funds, cheap loans, and also got its own companies orders to build infrastructure in these companies, like they built ports for China. And they have done a lot of infrastructure development in Africa. And as a result of which, their capital is stuck out there, and those countries are not in a position to pay back. And the US and EU is worried about China's increasing dominance in Africa, and they're also trying to compete with China to provide more financing and facilities for the African countries. So all these things are there on the backdrop, in the background for China, while it's trying to revive its own economy. And China and Japan have a challenge that is totally opposite to what is facing United States. Europe has an even different problem. When we talk about Europe, Europe is heavily dependent on Russia for oil as well as wheat, and also for all kinds of minerals and materials like palladium and all. And even coal is coming from Russia. So at this point of time, having declared an embargo on Russian oil and gas, EU has got to get everything organized before the end of this year and before winter starts, so that they don't have a problem. And anytime you put an embargo on oil and gas, it's going to cause the risk of stagflation to go up. So Europe has the biggest risk for going into stagflation, and they are having a heavy inflation, and they have just started tightening their balance sheet, and they have started doing the interest rate hike, and they have increased the interest rate by 0.25% most recently, with many more hikes to come down the pike. So having said that, what is it that's going to happen to US stock market and the US dollar index? Let us go one by one. Let us take the case of Japan. If Japan was to do any kind of intervention to control the descent of yen below 140, then those actions taken by Japan is going to shore up the strength of yen, and as a result of which it will have to strengthen against the dollar. So the US dollar index is going to lose some steam because the fund is going to flow from the dollar index into yen. And what can be done to strengthen a currency is to raise the interest rate, and then global deposits will follow. And also you'll mop up the liquidity. Unfortunately for Japan, if they did that, what is going to happen is already weak economy is going to falter. So we have to see what Japan can do. There are various ways in which this can be handled. There are many monetary tools. So it's a cutting edge of economic management and monetary policy we'll be witnessing when Japan does whatever it does. But it's definitely going to have an impact on the US dollar index. Next, let us have a look at what China can do. China is having a very low productivity at this point of time because of all the lockdown and everything, and it has got a very low inflation rate, and China can afford to unleash some liquidity. And if China unleashes liquidity, what is going to happen? All that liquidity is going to be attracted by the US dollar index because the interest rates are higher, whereas in China it will be low. So people will borrow from China and they'll deploy it in the US. And that's going to compound the problem for the Federal Reserve, because the Federal Reserve will have to take even more aggressive steps to control. So where is the solution? I think there is one ray of hope. If global tariffs were removed and the free movements of goods and trades is re-established, then potentially we'll have some way of mitigating all these problems, and we can import deflation from China and we can export inflation from the US. So those kind of moves can happen. Now, if we were to look at Turkey has got hyperinflation, and Turkey is a big economy. And definitely what happens in Turkey is going to impact the rest of the world. They need to increase their interest rates aggressively. However, the ruling regime out there doesn't believe in increasing interest rates. So they are kind of modeling what is called as Islamic banking. In Islamic banking, it's considered that interest is considered to be sinful. So the way Islamic banking operates is that if you want to buy a house, then the bank will buy the house and you pay the rent to the bank. And after a certain period of time, the house becomes yours. So basically what you're doing is you're paying back the bank as you would pay a mortgage, but it is called rent. That's how it goes. And again, there are administrative fees and other things that are done by the bank in order to keep it as a going concern, to keep the bank as a going concern. So when Turkey, in the face of hyperinflation, starts reducing the interest rate and tending towards zero, it's going to spike the inflation further. And Turkey has got huge imports of oil and wheat, both from Russia and Ukraine. So it's going to have a big problem. And when economic problems go beyond a particular level, there is revolution and there is violence and there is social unrest. So we have to watch the space and see how the government is going to tackle it, because I'm sure the government is aware of what is happening and it's aware of the risks that it's facing. So we'll have to see what kind of approach Turkey is going to take. And when we then come over and have a look at US at this point of time, US dollar being the strongest, the US dollar index is going to attract funds from all over the world as US becomes the leader in interest rates, as the Fed keeps on putting a 75 basis point hike. And now, in this backdrop, I would like to ask you the question. When we look at our technicals every day and we look at our exponential moving averages and we look at RSI and MACD and all that, we are just looking at one of the dimensions that is very, very dynamic and very, very small. There are so many other dimensions in the context of which the market resides, and any of those can affect our market on any given day. And on top of that, as genomic investors, we are investing in a cutting edge field where we still have to prove an FDA approval for at least one of the therapies before we can start saying that genomic companies are sound companies and they have proven technology. We know that we can have a CRISPR technology deployed to edit DNA. We know that there are lots of therapies going on. They're in advanced clinical stage. But until any of them gets approved and we start seeing money coming into any of those companies in our watch list, they're all highly speculative and highly risky growth stocks. And in the current environment, they are likely to face a lot of challenges because people are going to go to the relative safety of an established company which is able to command prices, which has got good cash balance in the cash in the balance sheet, and which is able to pay dividends. So that's the context in which we are. So I would like you to think carefully about what I have explained to you today, and let me know what you think about when our economy is going to come out of this funk. I am thinking that it's still going to be probably at the end of the fourth quarter or early next year. We need to watch patiently. So if any of us is going to deploy capital into the stock market, we have to do dollar cost averaging. We have to be very careful because at any point of time, you might find inflation such that your bread is going to cost more, milk is going to cost more, butter is going to cost more. And probably you will decide that you're not going to drive, you're going to do everything remote because gas is too expensive. So when a situation like that comes in, you will have no option but to dip into your stocks, and you will not be alone. There'll be thousands and thousands of people all around you who are going to be trying to sell their stocks to take the money, and the stock prices will fall further. That risk is there. I'm not saying it's going to happen, but that risk is always there. So at this point of time, I think the rich people are the ones who will be able to further make money out of the situation, and further the division between the haves and the have-nots is going to increase, and the 1% which is rich is going to become even further richer, because they'll be able to invest in some of these companies without thinking twice and forget about it for another 5 years. And by that time, all the problems will be sorted and everything will be going up and they'll reap the benefit. Whereas retail investors like us, if we are not careful and if we get greedy and if we start pumping money into the market at this point of time, like there is no tomorrow, we probably won't have the stamina to wait for 2 or 3 years to reap the benefits. That is my fear. So my advice basically, again, this is my personal advice. It's not a financial advice. my thought process is that when we invest in this market, when things start looking tempting, when you see Microsoft at such a low price, or when you see CRISPR Therapeutics at low price, or DNA at low price, the low prices are going to last for a while, in my opinion, and we got to be safe. And the safe method is to start dollar cost averaging on the way up. At this point of time, I have liberated some cash, but I have not yet deployed it. I tried to deploy it a couple of days ago, but I didn't get the price at which I wanted the shares. So that's all I have for you in this video today. As conclusion, I'll tell you that the whole objective of this video is to say that our stock market, the NASDAQ, and our genomic stocks reside in a larger context, and the larger context is in a very messy state at this point of time. And what happens in one country is going to affect another country, and what happens in US is going to affect the globe. So we have to be careful. Just the RSI and the MACD and the trend lines are not going to predict everything. So there will be days when we expect something to happen and something else totally different might happen. And this is the reason why that's happening. With that said, I would like to bring this video to a close. If you liked this video, please press a like out there. It will help YouTube to introduce our channel to more viewers. And if you're not yet subscribed, please subscribe and join our community and help us grow this channel. Thanks and have a great day. Bye for now and enjoy your weekend.